Stocks rising today after the Federal Reserve yesterday signaled it will delay but not slow interest rate cuts. For more on how investors should be playing the higher for longer Fed, let's welcome in Tony Dwyer, the chief market strategist for Canaccord Genuity. Tony, what was your read on the Fed when all was said and done, and does it change anything in terms of how you're viewing strategy?
So the late Marty Zweig had two phrases, especially for those that are new to investing: don't fight the Fed and don't fight the tape. And what they've been telling us since the dovish pivot is that they're going to be cutting rates, not raising rates. Yesterday, he really reinforced that when he said that we're at a cycle high in rates and we're still looking to cut 3 times this year. Now, it's borderline between 2 and 3, so you could have a nuance there. But ultimately, the Fed is in easing mode, and that's benefiting the tape.
Tony, they also lifted their projections for economic growth this year. Does that kind of dovetail with what you're seeing?
Yeah, it's kind of interesting. They increased their estimate for growth. They increased their estimate for inflation, but they didn't decrease their estimate for how many cuts they're going to have, or the fact that they're going to stay cutting versus higher for longer, or even raising rates. The problem that I have, Josh, is the data that's coming in is wholly incomplete. One of the things, if you remember back in January, as you can see on that chart, the Fed has raised rates in a historic way. It's the fastest rate hike cycle in history. So you would imagine that it would have had a bigger economic impact. But there's been a source of capital that didn't exist before in the private credit market that has replaced bank lending and other area capital markets activity. Those areas kind of held, the private credit market kept things afloat last year, and it kind of neutralized the impact of an inverted yield curve and higher interest rate environment on bank lending. And we're trying to figure out, the market's trying to figure out where we stand in that. At this point, it's really tough to get good data.
Well, and it also sounds like, if what you're saying, if indeed private credit was really one of the main reasons here, does that permanently, or at least for as long as we can see, sort of decrease the effectiveness of interest rates as a tool, right? Either,
Yep.
Either tightening or loosening.
As long as employment stays fine, that's the key here, Julie. As long as employment stays fine, because it's a service-based economy, 67% of the U.S. economy and consumption is service-based. So as long as everyone's working, you have money and increased money to spend. So here's the rub. In January, remember how many people like me came on shows like yours and said, well, there's 335,000 jobs. The Fed may not even cut rates this year at all. And then all of a sudden, fast forward to this most recent report, the prior 2 months were revised downward by almost 175,000 jobs. So that negated that real upside surprise. So the problem is that the data coming into the Fed and us is very incomplete. Companies aren't responding in time to the Bureau of Labor Statistics survey to actually get good reads. So the Fed has had one time in their history where they've got it right. 1995, after a tightening cycle, a sharp tightening cycle, they got it right. It was a soft landing, and the market stayed strong. That was when it was good data coming in. They're having a challenging time getting good data now.
And so, Tony, bottom line, though, listen, we had a big update yesterday, green across my screen here again today. Yep. I'm just curious, where do you think we head from here? How does this market play out here in next 6-12 months?
So as I said, don't fight the Fed. Well, don't fight the tape. Earlier this year, after that Fed pivot, the December dovish pivot, as it's called, there was a breath thrust that no matter how you tear it apart, it was a good move in the market that each time has suggested 9 to 12 months out, you're up almost literally every time. That doesn't mean it's going to happen, but that's what's happened when you have these kind of breath thrusts. So there can be a lot of churn in the middle of it. But ultimately, by the end of the year, it should be a pretty good year. You don't want to fight. When the folks printing the money are telling you their game plan, you tend to listen, especially if the tape is agreeing.
And now, instead of following the Mag 7 or large cap tech or whatever you want to call it, do you want to follow that breadth? In other words, as I noted earlier, You got the S&P equal weight beating the broader market today. You have the Russell really beating the market today. Is that where you want to be?
So to be clear in my prior comment, I don't think you want to fight the tape, but you don't necessarily need to chase it, because if you're looking at the S&P 500, you're up on really 7 to 10 stocks, not just in tech. It's been in multiple industries, but it's been those mega cap stocks. So what makes you want to buy the average stock or have the troops catch up with the generals? And Julie, as you know, for me, it always comes down to earnings. Literally last year, according to my earnings wizard at LSEG, TJ Dillon, S&P operating profits would have been negative last year if it weren't for the Mag 7. That's true again this quarter. So what I think we're starting to sniff out in the bottoming of the equal weight relative to the S&P, or the Russell 2000 relative to the S&P, it's starting to sniff out that changes later in the year, where the earnings growth isn't dominated just by 7 stocks. It's more evenly distributed. So if I have a Fed that's easing interest rate policy, if I have a breadth thrust where investors are kind of, a little bit too much right now, chasing the gains in the market, but you have earnings justification for a broadening, not necessarily another 10% S&P move, but a broadening where there's more stocks participating with the move, I think you have a good setup for that as we go into the year end.
Tony, we always love having you on the show. Thanks so much for joining us today.